Federal Drive is presented by GEHA, Government Employees Health Association, proudly providing health and dental benefits to federal employees and their families. Visit GEHA.com.
And now, the Federal Drive with Terry Gerton, sponsored by GEHA.
Welcome to the Federal Drive on Federal News Network. It's Tuesday, May 12th. I'm your host, Terry Gerton, and I'm glad you're here. Coming up on this hour of the Federal Drive, if you feel unsure about retirement, you're probably asking the right questions. Plus, innovation has expanded choice in consumer finance, but it's also exposed limits in how well regulation keeps up and who ends up bearing the risk. Those stories and much more ahead during this hour of the Federal Drive. We begin with this. A Trump-appointed advisory committee is urging sweeping overhauls at the Federal Emergency Management Agency. The FEMA Review Council approved its final report to the president last week. The group's report does not include earlier draft recommendations that would have cut FEMA's workforce by up to 50%. Federal News Network's Justin Doubleday joins me now with the details. Justin, great to have you.
Good to be with you, Terry.
We've been waiting on this report for a while now. What are the big headlines that made it into the final report?
Well, as we've known all along, the FEMA Review Council was really looking at how FEMA could, so to speak, take more of a back seat to state and local governments when it comes to disaster response. And that is the overarching theme, I think, of their final report, which is shifting FEMA into what they call kind of more of a support role with state and local led disaster response. Now, many people would say that's what FEMA already does, but that is certainly what they were really looking to emphasize through this report. And so the major recommendations include streamlining how FEMA disperses disaster funds to make it faster, mitigation grants and other types of assistance doing the same there, replacing the hazard mitigation grant program, reforming the National Flood Insurance Program, and then, really importantly, raising the threshold for when an event would qualify for federal disaster assistance. So essentially, less disasters would have that FEMA assistance come into play. And so all of that went into this big 75-page report. It's pretty long. I would recommend anyone who's really interested in the details to go look at the details, go look at the report. But it is now on the president's desk for implementation, and we'll go from there.
Justin, one of the things everyone has been waiting for is the report's recommendations on FEMA staffing. What does it have to say? Give us the headlines.
Yeah, really interesting. It does not include some recommendations from a draft version of the council's reports to cut FEMA staffing by about 50% over the next 2 to 3 years. That draft came out late last year. It circulated widely online. It was leaked. And, it showed that 50% staffing cut. It had recommendations around something called FEMA 2.0, and that's no longer in there. Instead, this final report talks about, a transformed FEMA, quote unquote, and it calls for a strategic review of workforce requirements to ensure that especially FEMA has the right balance between headquarters and field personnel. You heard a lot of the council members talk about that, but there isn't any more explicit discussion about cutting FEMA staff. And I think if you look at what's happened over the last few months, Secretary Kristi Noem is now gone. She was, really focused in a lot of ways on cutting FEMA staff during her tenure. She was focused on FEMA 2.0. Now, Secretary Markwayne Mullin is leading DHS, and he's already started to take a different tack toward FEMA.
The FEMA workforce was, of course, significantly impacted by the DHS shutdown. 78 days, I think. How has the workforce situation changed at FEMA in recent months?
Yeah, I mentioned the transition from Noem to Mullin. That's really been a big difference so far, at least, in terms of during Noem's tenure, FEMA workers left en masse. There was about 2,500 departures under the deferred resignation program and other voluntary departure programs last year. FEMA workers signed a public dissent letter that called out those controversial policies, and several dozen of them were suspended last fall. And then earlier this year, FEMA started not renewing on kind of a blanket basis these contract workers at FEMA called the cadre of on-call response and recovery employees, or core staff. And there were hundreds who weren't renewed when typically they would be renewed unless there was, no longer a need for a specific person in a specific area. So that all led to fears about their cutting FEMA staff. They're even getting ahead of the FEMA report in cutting FEMA staff. A lot of that has changed now. Now, under Secretary Markwayne Mullin, just actually a couple weeks ago, the FEMA workers who were suspended were reinstated. FEMA has also started offering the jobs back to those core employees who had their contracts not renewed. And so there's certainly been a tonal shift at FEMA. And as I said, that kind of came through in the final report that the council delivered. I should mention the DHS secretary serves as the chairman of the council. And so there was certainly some interplay there, I think.
There were a lot of other recommendations that were floating around, including making FEMA a separate cabinet agency. Where does all of that land? What are the other big headline recommendations?
Well, interestingly enough, that draft report recommended keeping FEMA within DHS, that draft leaked report that I mentioned that came out under Secretary Noem. This final report doesn't take a position on whether FEMA should stay or should not stay within DHS. And so that's pretty interesting. There's also a big recommendation in there as far as cutting administrative costs tied to FEMA's grant programs. And that could certainly tie into FEMA staffing, but it also ties into just what state and local governments have to do to comply with FEMA requirements. The report says almost 25 cents on every dollar that FEMA puts out through grant programs is an administrative expense. So that's audits and all those types of things. And the recommendations include streamlining grant programs, establishing caps on administrative overhead, strengthening post-employment rules for FEMA employees to mitigate any sort of conflicts of interest that might come from going from FEMA to consulting on FEMA assistance. So there's a lot of recommendations there on administrative overhead that were pretty interesting as well.
When this report leaves the president's desk, does Congress have any activity or responsibility in the implementation of any recommendations?
Yeah, it's interesting. This report, a lot of it will need congressional action to actually be implemented, especially when you look at things like replacing certain programs or streamlining individual assistance, reforming the assistance that goes to state and local governments and counties and things like that. That will require Congress to take action. There are some things like the workforce review that we talked about at the top that certainly the administration could do on its own, but that workforce review is contingent on reforming a lot of those big programs at FEMA, and that will require Congress to act. Now, Congress has been advancing a bill called the FEMA Act, and it's in the House. It passed to the full House last year. It's now got up to, I think, last I checked, 70 co-sponsors, bipartisan bill. That would remove FEMA out from under DHS and make it its own independent agency. And again, the final FEMA Council report did not take a stance on that. It would also implement some of the same recommendations around streamlining programs, disaster response programs that the FEMA Review Council recommends. So that's where Congress would be able to take this council report and potentially include aspects of it that aren't already in that bill. But we'll see what lawmakers say, because even Republicans have had some issues with how the Trump administration has run FEMA so far.
Still much to watch. Perhaps there'll be some oversight hearings in the future.
Yeah, we'll see. Congress has a lot on its plate, but we'll see.
Federal News Network's Justin Doubleday. Justin, thanks for joining me.
Thanks, Terry.
You can find his full story at federalnewsnetwork.com. Up next, if you feel unsure about retirement, you're probably asking the right questions. This is the Federal Drive with Terry Gerton on Federal News Network.
Tune in Tuesdays at 10:30 a.m. and 2:30 p.m. for the Innovation in Government Show, sponsored by Carasoft. Hear from the industry leaders advancing the technologies shaping how agencies modernize secure operations and deliver better services. Innovation in Government covers what is changing now, what is working from cybersecurity and cloud to data, AI, and emerging technologies. Listen to Innovation in Government, Tuesdays at 10:30 a.m. and 2:30 p.m. on Federal News Network. Search Innovation in Government.
Welcome back to the Federal Drive with Terry Gerton on Federal News Network. For many federal employees, retirement planning stalls at the same point. Uncertainty about whether the numbers, timing, and assumptions really hold up. Instead of chasing certainty, there's a better way to assess readiness. Joining me to explain how feds can evaluate their retirement readiness using structure rather than stress is certified financial planner Tiago Glieger. Tiago, thanks so much for joining me.
Thanks, Terry. Good to be here.
A topic that is on a lot of folks' minds these days is retirement. Folks who retired last year or at the end of the fiscal year, at the beginning of the fiscal year, at the end of the calendar year. There's a lot going on. And a lot of times people are concerned about when to pick the right retirement date. So as you start people thinking about retirement, what are some of the things that come up in that discussion?
Yeah, there's a lot of different components to retirement planning, Terry. And, I think the first thing that we encourage people to remember is to just make sure that they are fully eligible to retire with benefits, right? When it comes to federal service, there's a lot of different rules. So we have things like your age in service requirements for the pension. Are you collecting an immediate pension? Is it going to be a deferred pension? Are you going to postpone the benefits so that it's not a reduced pension later on? Then there's also health insurance. It's one of the greatest benefits we have through FEHB in federal service. And so you want to make sure that you have continuation of FEHB into retirement before you actually leave and that you qualify. You checked all the boxes. Now, for the most part, most federal retirees are going to have that health insurance in place. But here's where I see it come into play sometimes where the spouse might have private sector health insurance coverage, and sometimes the coverage might be a little bit better than what's through FEHB. So then maybe they're taking care of their family through that. And then when they go to retire, they didn't realize, hey, we have to be on the FEHB plan for at least 5 years for us to carry that into retirement. So that's something to keep in mind as well. And then there's other benefits like the annuity supplement. If you're not familiar with that term, it's the special retirement supplement, as we call it. So it's the Social Security Lite. And I have seen people, Terry, where, if they had stuck around for 6 months longer, they could have qualified for the annuity supplement. And in some cases, that would have been tens of thousands of extra dollars right at the beginning of retirement.
When someone is thinking about retirement, one of the things that comes up is actually choosing a retirement date. There are websites, I've seen them, about the best day to retire, but there's more to it than just a date on the calendar, right?
That's right. There's really two categories that I like people to be thinking about. There's the financial component, which is what most people tend to focus on. And then there's also the psychological component. So when it comes to the money, the first thing is you have to understand, are you going to have enough income between your pension or maybe Social Security, the annuity supplement, and the money that you've saved to be able to keep living your lifestyle and doing the things that you want to do, taking care of yourselves? Do you have a large enough nest egg, as we call it, which is where we've squirreled away all of the money in the TSP and other accounts so that we can continue to live our life ever so increasing because of inflation, and then also addressing taxes, which is a big part of retirement planning too. And then actually thinking about taxes too. This is, when it comes to the money, taxes tends to be among the largest expenses that retirees are going to face. And if we think about things like home renovations or college expense for our kids, those are big expenses, and we do a lot of planning around it. But seldom do we think about taxes in the same kind of way. And so if it's going to be so big, we need to pay a little closer attention. Same thing when it comes to healthcare and other insurance. That's all the money stuff. But then the psychological element, this is the one people tend to not really think too much about. They just think, you know what, I'm retiring because I don't want to work anymore. And I will tell you from not personal experience, but our clients, that the not working is cool for about 3 or 4 months, and then that's it. So we like to see people retiring to something rather than just from their current situation. So what is the purpose for waking up every day? Who are you doing things with? What are you enjoying in terms of hobbies? Are you volunteering? Are you traveling? Right? And so those are things that are really important because the satisfaction is just important as being financially safe.
That is so true, and I've seen it with many of my friends as well. What are you going to do when you don't have to do anything?
That's right.
Tiago, one of the other things that is important, and I think it relates to that psychological readiness, is people who actually start evaluating that and say, maybe I'm not ready to retire. I'll just do one more year. And you call that a trap. Tell me why.
Yes, the one more year trap. I've had clients who have been retiring in just one more year for about 4 years. And it's very easy to slip into this one more year because sometimes there is a good reason. Okay, so sometimes we are looking at maybe an additional benefit, such as if you're 61 years old and you have at least 20 years in federal service, hey, maybe working those 8, 9, 10, 12 months to get yourself to 62 gets you 10% extra in your pension. That might be financially worth it. But other times, I think sometimes it's people that are maybe just afraid of actually making this change. And they're calling that fear prudence, right? And this is something that can just be around, we don't know what we're going to do yet. We're not sure if the money is going to be enough. We want to grow our TSP more. We want a bigger pension, or really just the idea that change is very hard for people. And so there are some risks in doing that, right? You could get to a place where you really become unhappy. So you're starting to burn out. And then there's also the situation where we don't really know what our health is going to look like. We could be very healthy until we're not, right? And so I think that we have to think about our priorities in terms of what is our money for? Is it about getting more money, or is it about taking care of ourselves? And at some point, enough is enough.
Certified financial planner Tiago Glieger is at RMG Advisors. Tiago, let's keep on this financial thread here. Obviously, when a person retires, their income from their job stops. But what are the other sort of financial changes that occur when retirement begins?
Yeah, when your income goes away, it can be a little scary. But the good thing is that a lot of federal retirees are going to get what I call the retirement bonus, which is your annual leave lump sum payout, right? And so if you've accumulated a lot of annual leave, you are able to get that as a lump sum payment, which is kind of nice because in some cases it could be, again, tens of thousands of dollars. And when you leave service, you don't start getting the pension immediately. There's something called the interim amount that comes between when you leave and when the pension is actually finalized, which can take a few months. You can find those timelines on OPM's website. And that lump sum helps you to have a little bit of extra cash in the bank. So that's the first thing. Now, the health insurance is also something that is often misconfused. Now, the health insurance is often something that confuses people where they believe that they're simply going to lose health insurance until their pension starts. And that's not true. OPM is going to take care of that as long as you qualify to carry FEHB in retirement. So you don't have to worry about that. They are adjudicating for that in your pension, making sure those premiums are being paid. But the biggest change of all, Terry, I think, is this idea that now you are responsible for creating your income. Yeah, you're going to get a pension. In some cases, you'll get a little bit of an annuity supplement. But then what? You have this big pile of money that now you have to figure out, how do we start taking the money out? How do we invest in such a way that it can create that income today, 10 years from now, as inflation comes in? How do we deal with taxes? And so all of these pieces that we've been contributing toward, now we're taking care of ourselves, and we have to make sure we're aware.
And so as you start to think about the complexity of all of those different pieces of income streams and taxes and insurance payments, how early should federal employees begin preparing for their retirement exit?
I really like for people to start planning this at least 6 to 12 months ahead. But truthfully, I think a couple of years is really that magic spot because it gives you enough of a runway to start thinking about what's going to need to be in place. If your income's going to go away and you're just going to have a pension, but it's not going to start for 3 or 6 months, depending on the backlog in OPM, you're going to need to start accruing some cash and saving a little bit of extra cash so you can bridge yourself after you retire. That can take months, right? We've got expenses that we're dealing with every month. So 2 years gives you a good time to start thinking about that. Another thing is that you can start to pay down some of those debt. If you've been carrying any student debt, you can accelerate that. If you're dealing with college for your kids, maybe you're close to paying off a mortgage, you might consider accelerating those because when your income goes away, those expenses can possibly go away as well, right? So I think also the process of going through financial modeling and really working through a plan takes time, right? How long do we go through the process of coming up with a kitchen renovation and what we really want to do, right? We want to make sure we're dedicating months and months and months and months, if not at least a couple of years to the process.
When you think about some of the things you've just mentioned, there's also Social Security and practice maybe living on that retirement income for a while.
That's a really good idea. And I'm really glad you brought that up, Terry, because it starts to put into place that muscle memory of, hey, we need to be more conscious of how we're spending right now. When people retire, they're often making the most money they've ever made up until that point, right? And so sometimes maybe they find themselves not budgeting as carefully like they should, or they've always have enough income to be able to pay off the card each month. And so we want to start to live, as you say, practice living in the the amount of spending that is going to be responsible in retirement.
I've been speaking with Tiago Glieger. He's a certified financial planner with RMG Advisors. Tiago, thanks as always for such practical advice.
Thanks, Terry.
We'll post this interview at federalnewsnetwork.com/Federal Drive. Subscribe to the Federal Drive wherever you get your podcasts. Still to come, fixed price contracts assume stable requirements. Federal missions rarely cooperate, and the friction between the two is back in focus. But first, innovation has expanded choice in consumer finance, but it's also exposed limits in how well regulations keep up and who ends up bearing the risk. You're listening to the Federal Drive with Terry Gerton on Federal News Network. Welcome back to the Federal Drive with Terry Gerton on Federal News Network. From fintech tools to new credit models, consumer finance has changed faster than the regulatory framework around it. Todd Zywicki says that gap is a central focus of the new Institute for Consumer Financial Choice at George Mason University, which is designed to bring more empirical research into consumer finance policy debates. Professor Zywicki joins me now. Professor Zywicki, it is great to have you on the show. Thank you for joining me.
Thanks, Terry. It's great to be with you.
Consumer finance protection, that's been a topic of interest over the last few months, certainly with the Trump administration, but even more broadly, going back quite a while. When you think about how consumer finance policy actually functions in practice, what part of this system is really under strain right now?
Well, it's a fascinating time to be doing all this. As we know, sort of the internet has exploded consumer finance. We see stable coins. We see more and more people investing in the stock market. We see all these different sorts of innovations in fintech and that sort of thing. And so we're really at sort of a historic point with the opportunities for consumers, for innovation, for competition, and more choice. But at the same time, that brings with it new threats to consumers, new products, new ways of people understanding things, and that sort of thing. And so we started this new center, the Institute for Consumer Financial Choice, me along with my co-founder and co-director Tom Miller, who's an economist, to update the laws, to study the laws, to understand what's going on with consumers, how consumers shop for products, and how to make the whole financial system work better for consumers.
Are those similar to the functions that the CFPB might have been performing if it had been fully operational?
It could be, yes. And as you know, the CFPB has been a bit of a political football since its beginning, and sort of trying to figure out sort of the extent to which it's going to promote innovation and choice versus protecting consumers. The more general challenge, I think, Terry, is our consumer financial regulatory system is really still premised on a logic from the 1970s and 80s, right? These long disclosures, all these papers. Just think about a mortgage closing, right? And that stack of documents you get. And what we see today is we're not using the same products we used back then. We don't consume information the same way we did things back then. And so what we really need is a system that can kind of spring forward, that the CFPB could be helpful with. Congress needs to be involved. And that's what we're trying to do, is kind of push forward and think about a new way of sort of getting beyond that 1970s model to a more modern age of consumer finance and financial protection.
The challenge that you're addressing here, the lack of speed and responsiveness in our regulatory system, crosses all kinds of sectors, but it may be most personally relevant here in finance when it's really difficult to figure out if stablecoin is reliable. Yeah. Should I buy gold bars? What's happening to inflation? Who knows? How do you imagine the center getting in the middle of all of that? What do you hope it is able to do?
Yeah, and you know, there's a lot of groups out there, existing groups that are sort of consumer protection groups, and you know, and they serve an obvious function for consumers, protecting consumers, educating consumers. But I don't think there's a lot of groups who are sort of taking the approach we are, which is a really comprehensive integration of economics, policy, law. My background, I've worked both at the Federal Trade Commission and the Consumer Financial Protection Bureau, so I've seen it from that perspective. I also have a graduate degree in economics. And so what we're trying to do is bring this integrated view of the world, which is how do we integrate economics with technology, with consumer protection to give consumers more tools to navigate this incredibly complex, both complex but also exciting marketplace, where we now have more choices than ever before that, if handled well, can really make consumers' lives a lot better, but also create a lot of new pitfalls for consumers.
When you talk about this, the new options in the financial market, I mean, there are so many sources of information, reliable and unreliable, about all of these different kinds of tools and investment, the word I want, schemes, maybe.
Right.
How is a consumer supposed to make sense of all of this?
Yeah, it's very confusing. And, we've also got to deal with debt collection and, all the headaches around credit reporting, right? All these different sorts of things that people have. And that's really the challenge, right? Which is, in my view, the way the system is structured right now really isn't up to the task of a 21st century internet phone-based mechanism by which consumers are consuming information, making choices, and the like. And so kind of integrating, what we really want to do is integrate good primary research, right? Economics, law, and policy, and then make that applicable, kind of bridge that gap between academia and the real world, where you could take those ideas and make them actionable to actually improve consumers' lives through things like filing amicus briefs to inform courts, whether it's regulatory filings or just doing like the initial project that we're going to do next week on May 14 and 15, which is a big academic research symposium to talk about sort of important issues at the intersection of public policy and economics and law.
Todd Zwicky is George Mason University Foundation Professor of Law at the Antonin Scalia Law School. Todd, let's come back to the financial market for a minute. The fintech sector is way ahead in a lot of technological innovations, perhaps not always with the consumer's welfare at the center of that. We've seen a lot of conversation on the Hill about regulating cryptocurrency, and that gets tangled up in all kinds of things. And then within the executive branch, there are a number of federal agencies whose jurisdiction crosses here. How can the center help make what is a very complicated space a little simpler and clearer for people to participate in effectively?
Yeah, great question. Terry, it's interesting. In 2020, I was the chairman of a big task force that the CFPB put together, where we put together an 800-page report with 101 recommendations, basically on the future of the consumer financial system. And why I flagged that was what we saw during that period, of course, was COVID. And what we saw during that period, I always say, was about 10 years of innovation and technological development truncated into about 9 months of time, right? Where everything went online. All of a sudden, you got this explosion of alternative underwriting, because people didn't have to pay their bills, so the traditional FICO scores didn't operate. And so what we had was this huge amount of activity that kind of sprung forward. And since that time, we've kind of been trying to catch up, I think, with a lot of what's going on. In this, as you suggest, there's two obstacles. One is this regulatory fragmentation that you described, right? We've got a lot of financial regulators. The creation of the CFPB was obviously supposed to pull a lot of that together, but its current uncertain state obviously leaves a lot of that in flux. But the second thing is there's a lot of special interest jockeying around this, right? You've got the big banks who feel threatened by fintech startups and that sort of thing. You've got small banks that feel threatened by stable coins and fintech startups. You've got state regulators, you've got federal regulators. And what we're seeing now is a increasing divide between what's going on at the national level with the Trump administration and a lot of blue states that are becoming much more aggressive in sort of regulating consumer finance and kind of interfering in a lot of sort of interstate things. The final thing is the way in which the Supreme Court has changed its regulatory policies. I'm sure your listeners are familiar with, in terms of the deference that they give to regulatory agencies and that sort of thing. It's really cast a lot of uncertainty over this whole area, that we're kind of redoing a lot of things that it seemed like it had been settled law as we try to figure out our way forward in a world in which courts are going to be less deferential to regulators, where Congress is still kind of MIA. And so there's a lot of things going on right now, a lot of uncertainty, and a lot of potential for getting things wrong if we don't really understand what we're doing and why we're doing it.
We started this conversation talking about pretty esoteric investment vehicles, crypto and Bitcoin and some of those other things. But when I think back to the origin of the CFPB, we were talking about predatory lending, and individuals just basically trying to navigate day-to-day expenses. Not everybody is trying to figure out how much Bitcoin to buy. So where are the guardrails here around what is really relevant to the average consumer versus what kind of structures need to be built from a regulatory perspective for the broader finance industry?
Yeah, and that's always the challenge in a case like this, Terry, right? Which is that the growing proliferation of options, and fintech in particular is really good at this, right? Which is sort of personalized products, right? The ability to really get into fine-grained underwriting, to use different methods of looking at people's rental payments or utilities, rather than just looking at the traditional FICO score, which is a very crude one-size-fits-all measure. And so what we see now is this ability potentially to really create products that are really uniquely valuable to people. This is especially, I think, potential for traditionally under-included communities. A lot of the unintended consequences of Dodd-Frank and the like, of that sort of new regulatory overlay, was, I think, to create a lot of one-size-fits-all regulations to try to kind of protect people. But at the same time, it's had impacts like increasing the cost of bank accounts through Dodd-Frank, which affects minority and young consumers and that sort of thing. And so we saw a response. The response was fairly heavy-handed and sort of one size fits all. And I think, what we're seeing now is a clash between the efforts to try to create opportunities for consumers who don't fit in that bucket, younger people, minorities, that sort of thing. At the same time, we're trying to create this bulwark, this foundation that you described, of preventing something like the financial crisis from happening again.
When you think about the vision for the Institute for Consumer Financial Choice, what do you really hope to accomplish as you get it off the ground and running?
Yeah, great. Thank you for asking that. What we really want to do is integrate academic research and on how consumer markets work and how consumers make choices with policy relevant outcomes, whether it's in litigation or the like. And one of the things we've specifically tried to do with respect to this first program that we're doing next week is try to involve people from a variety of disciplines, economists, former government officials. We have the former deputy director David Silberman, who is the deputy director of the CFPB when Richard Cordray was director. We want to make it bipartisan. We want to create sort of an environment where we get a lot of different perspectives. I think one of the big problems in the world today when it comes to this is we kind of have this binary in our head about consumer finance, which is deregulation versus more regulation, right? This binary. And I don't think that's right. Properly done, good regulation can be good for consumers, it can be good for industry and legitimate players, and it can be good for the economy. And so trying to figure out how we harness technology, how we harness the innovations we see in the market to benefit consumers. This is really a bipartisan project, right? We all care about financial inclusion. We all care about making consumers, households more financially stable, capable, providing for good retirement savings and all these sorts of things. And so our goal and our plea is to help this maybe be a bipartisan project where people can come together and we could kind of think about how we improve the whole system, modernize the whole system to benefit consumers.
Todd Zwicky is George Mason University Foundation Professor of Law at the Antonin Scalia Law School. Professor Zwicky, thank you so much for joining me, and good luck as you get this important effort off the ground.
Thanks, Terry. And you can find us at Institute for Consumer Financial Choice. You can register for our conference next week, and we also have a live stream option if you can't make it in person. Thanks.
We'll post this interview at federalnewsnetwork.com/Federal Drive. Subscribe to the Federal Drive wherever you get your podcasts. Coming up next, fixed price contracts assume stable requirements, and federal missions rarely cooperate, and the friction between the two is back in focus. This is the Federal Drive with Terry Gerton on Federal News Network. Welcome back to the Federal Drive with Terry Gerton on Federal News Network. Federal execution increasingly turns on how risk is managed across contracts and capabilities. Recent policy signals are testing whether existing structures can absorb that pressure. Here to break down the root issues is Stephanie Castro, president of the Professional Services Council. Stephanie, thanks so much for joining me today.
Thanks for having me, Terry.
We've covered the recent White House EO on promoting efficiency, accountability, and performance in federal contracting, or as it's commonly known, the fixed price EO. And we've talked about a lot of different aspects, but I really want to hear from your perspective, from PSC's perspective, what this means for the contract community. One of the things we've heard a lot about is risk shifting. Tell us how this is resonating.
Before I do that, Terry, I want to thank you, because there are a lot of people out there calling this the firm fixed price EO. And it is not a firm fixed price EO. It is a fixed price executive order. And I want to thank you for noting that. So I appreciate it. So the risk topic is something that came up immediately upon reading this executive order. Now, this EO has been out for a couple of weeks, and we've had lots of conversations with PSC's member companies. As you'll recall, we have some 400 member companies, and 300 of them hold federal government contracts. And so this is something that will impact how they think about their risk profile, how they think about their proposals that they're going to submit. And let's talk a little bit about risk transference. So the conversation when we dork out about risk really is about, can you, as the government customer, clearly articulate your requirements when you put out a request for proposals? Are they specific enough? Do you have enough detail about what you're expecting as deliverables, what you're expecting for schedule, and what you're expecting for acceptance criteria, what will lead you to accept those deliverables on that schedule? And when contractors think about this, they go through cost estimation, risk modeling, and performance planning. So this is the ecosystem that we're talking about, Terry. And there's a lot of different aspects of risk within that ecosystem.
Well, it seems like my answer to your question about whether the government can have all of those ducks in a row is typically no.
Historically, it's been hard to line up these ducks, Terry.
Historically,
You're right.
It has. And so when you think about that, I mean, everything from a major weapon system to a support contract, how does the contractor build in the flexibility to respond to less than certain requirements?
So let's talk a little bit about cases in which there are well-defined requirements. These are oftentimes short-term contracts, not the 5 to 10-year contracts, because to be honest, if you have a requirement in year 1, it's probably going to change slightly in year 6, 7, 8, etc., or even year 3, given the pace of technology and evolution, right? And so it is very difficult to know in the out years what you're going to require today. And so contractors build in certain elements of flexibility for themselves. Part of that is also one of the risks that we should talk about, Terry, is the risk of inflation. Now, we have seen historically 2% inflation year over year, but you'll recall a couple of years ago, we had 7% inflation. And that was when a lot of our community really became acquainted with the term economic price adjustment. And so there is in FAR Part 16, a list of the kinds of fixed price contracts that you can have. And one of them is firm fixed price, which is not necessarily this EO, as I said. And one is fixed price with economic price adjustments. And that allows the contractor to request equitable adjustments given things out of their control, like inflation. And so EPA clauses are hopefully going to come back into the vernacular again, even though we are experiencing somewhere between 2 and 3% inflation right now. And I understand from the FAR Council, and specifically folks in the Office of Federal Procurement Policy, that this is on the table, having fixed price contracts with equitable price adjustments, EPA clauses in them. And that's good news for contractors, because it means they don't have to necessarily plan for inflation in year 10 when they don't know what inflation in year 2 is going to be.
In some ways, it seems like a fixed price mechanism is actually more expensive for the government than compared to, say, like a cost plus process. because the contractors have to price in that risk to the price they're going to bid, right?
That's exactly right. And so I mentioned inflation, which I think your listeners totally understand what that is, right? We deal with inflation on the consumer side all the time. But supply chain risk is another kind of risk where you can try to mitigate everything, but if a source of a critical element of your solution goes offline, if there's a fire in a warehouse, if goods are not flowing through the Strait of Hormuz, for example, that's really difficult to predict. And so supply chain risk is something that contractors are going to have to look at. They're going to have to look at cost estimation and risk modeling, as I mentioned. And into their model, they're going to have to take into consideration that they are going to sign a fixed price contract that holds them to that price. And how are they going to think about that in the out years? That is something that they will shift that cost to the government. So that does lead to higher costs for the government customer with a fixed price contract.
Stephanie Castro is president of the Professional Services Council. Stephanie, as this EO starts to shape new solicitations, how are contractors preparing and maybe getting ahead of the curve?
So before we get to that point, Terry, I will highlight an executive order in and of itself. It directs agency action, but it does not itself amend the federal acquisition regulation, et cetera. And so we do expect to see additional guidance coming out from the FAR Council and from the Office of Federal Government Policy. We are looking to see rule changes, et cetera. So those are the clauses that would be incorporated into a contract. What I would also highlight for you is as companies think about how they're going to deal with this or address their costs as part of their proposals, they should look about their pricing structure, their cost structure, as well as engaging early and often with their government customers to make sure that those statements of work, that those statements of objectives are as clear as possible about deliverables, schedule, and acceptance criteria, as I mentioned earlier.
Stephanie, there's a lot to talk about, but I want to change the subject a minute as we get towards the end of our conversation today. You have a lot of your contractors in the PSC community who are engaged in law enforcement. This is National Police Week. We also happen to be about 30 days out from the first World Cup games, our first big mega events of what is a mega event season. When you think about the intelligence fusion function that goes along with law enforcement, what are the contractors in this space watching now?
I'm so glad you mentioned that, Terry, and it is Police Week, and it is one of my favorite weeks here in Washington, D.C. It's just great to see law enforcement professionals come into our nation's capital and be celebrated for the work that they do. Intel Fusion, just so your listeners are equally familiar with it, that includes the collection, the integration, and the analysis of information that's across federal, state, local, open source intelligence, et cetera, in order to get a fuller picture, right? That is the fusion piece of it. And so contractors have played an Intel Fusion role for decades. It has gone on for a long, long time, regardless of department or agency. And so DHS is a huge customer, as is the Department of Justice, as is the Department of War, et cetera. And today's threat environment doesn't respect jurisdictional boundaries. You know, the threats don't care whether you're state, local law enforcement. They don't care. We also have transnational criminal organizations, et cetera. So contractors are playing that role in operating these fusion centers as well as supporting the collection, integration, and analysis. They're in it as a partner across the board, Terry.
What are the biggest challenges that they're facing? Is it the jurisdictional reporting? Is it just the massive amount of information out there?
The massive amount of information, Terry, is probably the number one problem. When you think about all of the information that we get, it is open source is stuff that you and I see, right? Whether it's on TV or our social media feeds, et cetera. But there's so much more that's going on out there. In collecting data, in doing data analytics, systems integration, et cetera, contractors, as I mentioned, are playing a role. I would also note that one of the big challenges that we are facing in recent years is the use of artificial intelligence to generate misinformation, false information, et cetera, and making sure that our community, whether it's contractors or their government, can actually sift through the wheat and separate out the chaff, right? To make sure that they are focusing on the correct information that's out there, and then they're not getting led down a hallucinatory path, right, from AI. And so that's one of the challenges that has come up in recent years that didn't exist, say, 10 or 20 years ago in the same way it does now.
And what is on PSC's agenda to support the contractors who are working in this critical space?
So we have every year a law enforcement conference that we had in February of this year. It was a great success. We had some great conversations with law enforcement, federal law enforcement personnel and policymakers. We are supporting as PSC those companies that are really have cutting edge capabilities in data analytics, in systems integration, and in that analysis. I do think if you look at our website and look at our company profiles, so many of them are active in the artificial intelligence space that I think leveraging those capabilities to make us stronger together is something that PSC can offer. And so as we move forward in this space, please look for that. We have so much to offer to federal law enforcement and also to state and local entities that I think the best is yet to come. We're going to move forward together.
Stephanie Castro is president of the Professional Services Council. Stephanie, thanks for joining me.
Thanks, Terry.
We'll post this interview at federalnewsnetwork.com/Federal Drive. Subscribe to the Federal Drive wherever you get your podcasts. The Pandemic Response Accountability Committee was originally scheduled to sunset in September of 2025, but the pandemic watchdog has an ongoing mission. It's overseeing another broad tranche of funding. The One Big Beautiful Bill Act, signed into law last year, will keep the PRAC up and running for at least another 8 years and tasks the committee with keeping tabs on the budget reconciliation bill. Ken Diffenbach is PRAC's executive director. He talked with Federal News Network's Jory Heckman about the committee's ongoing work.
We're doing a lot of work still related to the pandemic. As you may know, a couple of the programs have had their statute of limitations extended. So there are still cases that can be prosecuted. We continue to support law enforcement, a wide variety of law enforcement agencies. We support about 1,000 cases with about $2.5 billion in potential fraud losses. So that pandemic fraud work continues. But we also are starting to now shift into more prevention focus in the One Big Beautiful Bill Act, which I'm sure we'll talk about today, and also extending the use of our lessons learned in our other reports, because we found that during the pandemic, much of the losses could have been mitigated. So we're trying to make sure the right people are aware of those lessons learned so that we can not be in this place again when inevitably there's another disaster and there's lots of money that has to get out quickly.
Of course, even in the lifetime of the PRAC, the tools of the trade, the methods of going after fraud and investigating it have evolved considerably, AI being one of them. Can you tell me how the PRAC is using AI to identify potentially fraudulent payments?
Sure. Let me frame it first in the investigative world, the oversight world, and I guess in the journalistic world too. We're really doing three things. We're collecting, analyzing, communicating information. And what AI allows us to do in that space is incredibly helpful because it does things that a human being couldn't do as efficiently, as effectively, and certainly not as quickly. So we are leveraging those tools primarily in the analysis piece to help us identify patterns, trends, anomalies, connections, often hidden connections, purposely hidden connections, because that at its very root is what many fraud schemes are about, or their telltale signs, I should say, is identifying those transactions and those entities that need extra scrutiny. So we're using the data we've collected in the pandemic, the methodologies that we have adopted and sometimes invented, and leveraging all that information again to better be able to predict and identify the places where a human being, where an auditor, an investigator, one of our partner OIGs, where they can then put their efforts. Because without leveraging that technology, we, of course, are using our human intuition as to where the problems may be. We're using our historical knowledge, and that's not the most efficient way to do it. So we found some great success in building and leveraging and continuing building those tools to give people information they otherwise wouldn't have.
As far as the data that AI is being trained on to predict and identify those patterns that emerge, what are the types of data sources that have been most useful for the PRAC to train the AI and make them ready to do more of this work?
Sure. I always look at data as kind of the second or third step. The first step to me is always what risks are we trying to mitigate? Because every one of the thousands of federal government programs that disperses money has fraud risks. The programs that disperse money to individuals have certain risks, and during the pandemic we saw identity theft. We saw people lying about their eligibility. We saw people lying about their location, about their business history. But other programs have different risks about the eligibility for a contractor to do the work that they actually did. So we have always started with what are the risks we are most trying to mitigate? How do we mitigate those risks manually with people while they look stuff up or they check references, they do these things? And then how can we identify data sources that can automatically or much more quickly help us identify the problem areas, the patterns, trends, anomalies that I spoke about just a minute ago. So the data sources that we found to be most useful for certain kinds of risks are, of course, government data. There's public and non-public government data. There are a variety of commercial data sets, but we're very intentional at the PRAC about what data we want to obtain and, of course, how we want to use it, because there's really an overwhelming amount of data. Some of it is more useful and valid than others. There are, of course, legal restrictions on what we can do with certain pieces of data. And I'll add one other piece. We've had great success in doing yes-no validation in some instances where we don't need all of another agency's data. We perhaps don't want it, or perhaps they can't share it. But what we can do, and we have done, is gone to them with a list of Social Security numbers, dates of birth, and names, for example. In one of our public fraud alerts, we did just this. And we said, Social Security, can you just verify if you were issued that Social Security number? If you have, does your name match our name? And does your date of birth match our date of birth? Yes, no. So we weren't asking them to give us any data, just to tell us yes, no. From that, we're able to estimate that some 1.4 million potentially invalid Social Security numbers were used to obtain $79 billion in pandemic funding. And so that was a kind of a demonstration project, if you will, of the fact that a little bit of pre-award vetting, a little bit of verifying that simple kind of question could have potentially prevented a lot of fraud and prevented the pay and chase piece, which I know we're going to talk about today. So again, lots of work that we are doing in that area and we can continue to do with our partners.
That's fascinating to me because the data sharing can be something that does not happen quickly between agencies, that there can be statutory limits to what agency data sets can be shared with other agencies. And it seems like that yes-no validation really does get you the validation that you need, the checks that you need to mitigate fraud, while at the same time, cutting through some of the red tape, I suppose.
Yes, exactly. And there's lots of different ways you can do this. You can do this with income data potentially. I don't need detailed income data, but are they above this threshold, below that threshold? And to the data sharing point you just made, it is a real challenge because you have statutory limitations. You also have real resource limitations, because if I go to another agency and say, I'd like your data for this project, they may agree, they may support it, they may be able to do it, but you're asking them to invest resources in a legal agreement, in the transmission piece, in lots of other moving pieces. So it is not as simple it's not a simple task to just share more data and share it more quickly. There's lots of moving pieces and lots of reasons why it takes time to do it right.
I guess going back to the volume of the data, it is really hard to wrap your mind around some of the volume of the data that is being processed by the PRAC. Thinking back to pandemic programs, trillions of dollars going out to really an astronomical number of recipients. It seems like that's really part of the value proposition of AI, is just doing analysis on a volume of data that no number of human analysts could really tackle on their own.
It is. I think that's the heart of how this is valuable for oversight and for government in general, is you can very quickly cut out the noise and at least point you in a direction so that you know better how to invest your limited resources. I've been involved in investigations and in some ways in audits that do involve tens of thousands, hundreds of thousands of emails, of documents, of financial transactions, of text messages, everything else. And kind of the old school way to do it was to manually review those things. And AI now allows us to, like you just said, better catalog, better understand, better identify the patterns, trends, anomalies. So it's a real game changer in the oversight world.
That's Ken Diefenbach, the Executive Director of the Pandemic Response Accountability Committee. And that excerpt is from a conversation with Federal News Network's Jory Heckman and was part of our 2026 AI and Data Exchange. If you missed it, you can get caught up at federalnewsnetwork.com. The Federal Drive with Terry Gerton is produced by Eric White and Michelle Sandiford. Our web editor is Stephanie Wright. For the latest updates, stay with federalnewsnetwork.com or follow us on Facebook, YouTube, and LinkedIn. I'm Terry Gerton. Thanks for listening.